Good morning. It's Jeffrey Christian of CPM Group. Welcome to Silver Facts and Fantasies 2025. We began this process in 2021 when the COVID lockdown had canceled or postponed the PDAC. It was so well received that we've continued it ever since. We are first and foremost want to thank the sponsors. They sponsor not only this Fact and Fantasy webinar, but also they sponsor the book that comes out related to this. That book, sorry about that. That book will come out after the Sunday night reception. They also sponsor CPM Group's silver reception on Sunday night, the opening night of the PDAC conference convention in Toronto, which is really how all of this started. But we want to thank our sponsors. They are spread across the market. We have companies like Bear Creek, Electrum, Metallic Minerals, twice, Pan American Silver, Silvercorp, Silver X, Sinda Silver, Sunshine, Reyna mining companies. We have publications like Prospector News, Kitco Media, Corlin Economics Report. I think I caught everybody. And we have Eelo Solutions, which provides energy advisory services to the mining industry. As I said, the origin of these open question and answer periods was in 2021 when the PDAC did not occur in the first week of March. And as a result, we couldn't have our silver reception in Toronto. And in lieu of that, we had this online question and answer period. There will be questions. You can ask questions by typing them on your little control panel for GoToWebinar. You'll see a thing called questions, and you can type in the questions. We also have allowed people to send in questions ahead of time. There are about 200 questions that we have received, and some of them are really good. And we've been talking about how to deal with this because, sometimes these sessions last 2 hours, and we have about a 31 slide presentation here. Can you cover these? So I think we'll use these questions perhaps as stimuli for some of our bi-weekly videos on Tuesdays and Fridays that we post on YouTube. I will, for example, one, do big banks like JP Morgan still have large silver inventories, or have they been selling them like most in the West have been doing? Well, first off, yes, a lot of investors in the West and in other parts of the world have been selling silver over the last 18 months or so, taking profits at higher prices. But the banks are not investing in that silver. That silver, the banks that own silver, they lease it out. They are market makers, and they are providers of financial and physical services to miners, smelters, refiners, and industrial users, and others who use silver. And those users, for example, a fabricator, a jewelry manufacturer, or electronic company, or a solar panel manufacturer, will, rather than buy a lot of silver for working inventories, which ties up capital because silver is expensive, they will lease the silver in, and they'll lease it from a bank or a broker or a dealer. They'll pay a lease fee. And then when they sell their product and ship it, they'll call the bank and say, okay, I am shipping my products, then they contain 10,000 ounces of silver. The products I'm shipping today. What's your price of silver? Well, it's $32.25, which is approximately where we are right now this morning. And I say, okay, fine, I'm going to buy 10,000 ounces of silver from you at today's price plus your markup. And then I'm going to go and turn around to my clients that I'm shipping this product to, and I'm going to say, I'm shipping you this product. Here's an invoice. And the silver content is priced at $32.25, plus handling and interest fees. And here's the invoice. And in that way, the fabricator, the jeweler or electronics company or whomever, has a perfect hedge. They're buying in silver, selling the silver at the same time, and they're having their client pay the interest and handling fees, just like tariffs get passed on to others. They have a perfect hedge and they've freed up capital. So that's why banks and trading companies have silver inventories as well as copper inventories, gold, and other metals. And they're not investors. So they haven't been selling that stuff. They have been leasing it out and then buying new silver and selling new silver as it's used. So they don't necessarily liquidate simply because the price is high. Why this sort of information is critical again in 2024, it's pretty obvious. There's a tremendous amount of bad information circulating about gold and silver. There seems to have been an increase. People have always lied about stuff, not just gold and silver, but other stuff. But there seems to be an increased willingness to be dishonest about a wide variety of things. And that's definitely true in gold and silver right now. So the idea of CPM Group bringing level-headed, reasonable, fact-based, reality-based, research-based information to a broader swath of people in the precious metals market is good. We have to counter that bad information. We have about more than 600 people signed up for this. And we will do some post-seminar online viewing will be available. This thing will ultimately be posted someplace where people can see it. Good questions. We'll work on that. And you can always become a CPM client and follow up questions that we can answer one-on-one, or we do for our clients quarterly open forums where we don't have any presentation. We just open it up for Q&A. And if you were our client, you can participate in those quarterly open forums. Topics that we're going to include, we're going to talk about supply, demand, and inventory. So I'm going to try to go fast, even though I've been going slow up until now, so that we have time for questions. The factors that affect and determine the silver price and how we track them. Whether there's any truth behind the chronic silver myths, like the idea of draining the COMEX. Hey, that didn't happen in 2021. In fact, inventories are very high now. Bank manipulation, what really happens, what really banks are fined for, which is lack of oversight, lack of supervision, and metal scarcity. It's not exactly scarce. Why these myths are started and who profits from them? Pretty obvious. An explanation of above ground and refined inventories and unmined silver reserves. We've got some data there. How central banks' currency policies and practices relate to silver. I'm going to address that one right now. And then the relationship between silver, COMEX inventories and silver prices, which is not particularly a significant relationship, despite what some people will tell you. Central bank currency policy. Central banks, first off, there are people talking about silver becoming a monetary reserve asset for central banks. That won't happen. It won't happen because the silver market is too small and silver prices are too volatile for silver to be a monetary reserve asset for central banks. Central banks actually work together. They work with the IMF. They work with the Bank for International Settlements, and they agree as to what is a suitable monetary reserve asset. Gold, currencies, positions in the IMF, and SDRs. Those are the four categories of assets that central banks agree among themselves are liquid enough that they can be monetary reserves. Silver is too small of a market to really constitute monetary reserves. May have been several hundred years ago, but it hasn't been at least for the last half century. And the prices very volatile. The price is more volatile than the prices of gold and currencies. And as a result, adding silver to your monetary reserves would not necessarily help you stabilize the value of your monetary reserves over time, insofar as you had any significant amount of silver in your monetary reserves, it would increase the volatility of your total reserves in a way that central banks would find diminutive of their purposes. And as a result, central banks per se are not interested in silver as a monetary reserve. Now, their currency policies and the vacillations in their currency exchange rates as a result of that, that can and does affect silver, as it does everything else. And what we've seen over the last year or so is a flight to quality. So investors and central banks have been increasing their US dollar holdings and US Treasury holdings and gold. Investors have also been increasing their silver holdings, but not central banks. So central banks have seen the dollar strengthen over the last year or so in a way that has reflected the decline in their own currencies, and that all has an effect on stimulating investment demand for silver. This is a history of CPM Group's reports, with the exception of the little book at the top right left-hand corner. And that little book is a Handy and Harman silver report. Back when I started working at J. Aron in 1980, there were two companies that produced basic data on silver supply, demand, and what happened last year, and an outlook for what happened this year. Handy and Harman, which was a diversified refiner and fabricator of silver products, had this little booklet that they had produced going back at least to the turn of the last century. We have a collection of their books. In fact, when they stopped producing those in the late 80s, early 90s, they gave us their records, and they gave us their copies of the books. J. Aron started publishing these books that you see on the top, first as sort of like bound little things with the silver cover, and then they got fancier, and we had a silver embossed hardcover and spiral bound thing. And when I came to J. Aron in 1980, that was the type of silver report. We left J. Aron. J. Aron was bought by Goldman Sachs in 1981. We left as a group. We were the commodities research group at Goldman Sachs J. Aron. We left in 1986 to set up CPM Group as an independent, unbiased, precious metals and commodities research and consulting company. And we started producing what we initially called silver yearbook surveys. And you can see precious metal silver, the silver book on the bottom line. And we were producing that on a quarterly basis. We converted that over time into the silver yearbook, which is, as you can see from the 2016 version, translated into Chinese by the Huatong Silver Exchange in Shanghai and distributed in China in the Chinese language. All the way on the left is the World Silver Survey, the first World Silver Survey. We created the World Silver Survey for the Silver Institute in 1990. We had a 5-year agreement whereby we would take our silver survey that we were producing on a quarterly basis and strip it down so that it was more what basic investors needed. The Silver Institute had come to us in 1988 and said, why are silver prices declining? And we said, well, investors are buying less silver at that time, and banks and brokers and dealers have gotten out of selling silver and gold to investors. So there's a paucity of information. In addition to that, you had a rise of professionally managed money investment funds, and investment funds around that time started managing more than 50% of the investable funds in the United States financial markets. It's now up much higher than that. And those professional money managers had come out of stocks and bonds, and they were used to SEC oversight of information that was circulating in the market related to stocks, and SEC and other Treasury and Fed and OCC oversight of what was being published and said about bonds. And then you got to gold and silver, and it's like, okay, well, there's this company, CPM Group, and they're producing research. And then there's a bunch of other people who write about silver, but they don't necessarily have any regulatory oversight saying, well, you can't say that because it's patently not true. So the Silver Institute said, we'd like to strip down your silver survey and make a world silver survey once a year that we can hand out to better inform the market, including investors, as to the silver market. And we signed a 5-year initial agreement. We started the program with a 1990 report. And in 1994, we parted ways with the Silver Institute. And we started taking sponsors for our own silver surveys, which when John Wiley wanted to become the publisher of them, they converted the name to the Silver Yearbook. That's the history there. So why listen to us? Because we have a pretty good track record in calling, these are our intermediate term buy and sell recommendations in silver since 1980. And those are based on our macroeconomic research and our silver fundamental research. If our research were inaccurate, we probably wouldn't have gotten the buy and sell signals right. So the buy and sell signals sort of confirm in our minds that the way we look at the supply and demand for silver probably is accurate. So let's get into it. Silver prices, this is the price of silver since the beginning of 2024, started the year around $22, $24. In April, it started rising. It got into this range of $28 to $32. It stayed there for most of the year. Over the course of October, the prices of gold and silver rose sharply. Silver got up to $35. It came back off in November, tested $30, tested $29, and it's back up around $32. We're on record as saying that the price could spike a little bit higher, maybe $35 over the next few days, and then come off. But we're basically looking at a silver price that stays above $28 this year, possibly stays above $30 now, and possibly moves over $35 to something higher on an intraday or a shorter term basis. Just a longer term view, you saw a spike. These are monthly prices, so the spike here is up to $37. The price actually got almost to $50 in January of 1980. It came back down and got down to $5 in 1982, spiked back up, and came back down. Traded very low, $7 to $5 to $3.50 for much of the time until around 2005. That started rising. It got back up, almost touched $50 at the end of April 2011 on an intraday basis. It got over to about $44 on the daily settlement basis, or monthly average basis. Came back down, was trading around $14, $15 an ounce, and now it's back up to $32. Our expectation is that this third spike, significant spike, has further to go. There's a seasonality to both gold and silver prices. You can see that silver prices tend to be strongest in March and April and May. Then they get into the end of the second quarter, the beginning of the third quarter, prices tend to come off. There's seasonality in fabrication demand. There's a lot of jewelers and other manufacturers who take rolling vacations, 2 weeks where they'll take inventories. They'll call in people who will, with high capacity vacuums, vacuum the rooms where they're using their gold and silver so that that metal can be recovered and refined and reused. And there'll be some slight reduction as a result in fabrication demand. Investors also tend to go on vacation July and August, so they're not necessarily actively investing in gold and silver. They'll sit on the beach, they'll go to the mountains, they'll think about what's happened in the first half of the year, they think about what might happen in the second half of the year. They come back in September, October, November, December, they tend to start buying more, along with the fabricators. It's the same sort of pattern. The seasonal pattern can be overruled by developments that are either political and economic that affect the silver market and everything else, or silver fundamentals. If somebody comes in as a large buyer or seller of silver, you can see the silver price rise uh, and overrule the seasonality that you see here.